Welcome to part two of this special episode with Scott O'Neill and Steve Birch. In part two, Scott and Steve are going to talk about some of the larger growth trends that are taking place, and they will also cover some stocks that could do well in the next uptrend. Let's start about the process, what everyone should be doing to prepare for this uptrend. And we touched on the data, but let's go a little bit more into the data because really the O'Neill data has stood the test of time for at least the last 50 years. Scott, why don't you talk a little bit more about this?
Oh, I appreciate that. I think everyone should know that we are known, and this isn't, I guess this is some pride in there, but we're known to have extremely high quality, accurate data. And it's what Arusha said just a moment ago, that not all data is equal. It's very expensive to curate data and to make sure it's very accurate. And we have an extensive process of, and it really is, everything that goes in that database is checked multiple times. And it's very important. I mean, at the end of the day, you're putting your hard-earned money into a stock, into the market, based on the MarketSmith chart you're looking at, and it has to be accurate. Imagine buying a stock. It's kind of like at that cocktail party buying some rumor, what's the hot topic people are talking about, or buying a stock from some crowdsourcing website, right? Or buying it because of social media talking about it and hyping. And just think about the plethora of inaccuracies in all of those areas. And you come back to the William O'Neill database, and the standards are so incredibly high that you can have real confidence in that chart when you put your hard-earned money in against that.
Yeah, and so let's take it from that to really, so both of you were the creators of MarketSmith back in 2010. You took the amazing Daily Graphs Online product that I got started out with, and you made it better. You made it easier. What was kind of the thought process, really taking Daily Graphs Online and evolving it into MarketSmith?
Right, Steve, you ought to take that because you really were the chief designer.
Yeah, I'll take that. It was actually one of my first big projects for Bill, and Bill had asked me to, in 2007. You know, I joined. I was at William O'Neill, and he asked me to step in as the president and chief operating officer in 2007. That was right before the 2008 crash. You know, just perfect timing, right?
Yeah, exactly.
And you're, Arusha, you're right. For those that don't know the history, short history, but Bill had created a product in the 1970s, and Scott, you've told the story many times of how he did it over the weekend. And so when you look at that MarketSmith chart, that with the when you look at a weekly where it has some of the fundamental data on the left-hand column, and it has the pattern rec there on the chart itself, and we've got the log scale and just sort of the placement. Well, this is so similar to what Bill designed in the 1970s, and it was really meant for not a professional fund manager. We have another product called Panarray that has, believe it or not, it's like a supercharged MarketSmith. It really is. It's on steroids. It's got global markets, and it's got a lot of other stuff. But Bill designed MarketSmith, and he put in it, and it's got a tremendous amount of capabilities. He designed the Daily Graph product to really replicate what he had done in print in the 1970s. And so at that time, in 2009 and 10, there was a lot of change going on in terms of online applications. There was Flash out there. There was a Silverlight as sort of what technology would you use, and we made a decision to invest in the property, to completely revamp it from the ground up, and give it a new name, freshen the brand, and really think about the user base. What are they trying to do, right? So we really beefed up the screening. We even, a lot of the products that Bill had originally designed were very, very much can slim only, right? It was just, that's the way that the originator and founder wanted it. And we ventured out a little bit by putting the guru screens in, and we said, there are going to be times when people are not, they're more value centric, or they're more growth at a reasonable price, or they're just curious. They just want to learn about some of these different approaches to the market. And we've got a powerful enough tool and a really, really rich database. Why don't we put that in there? And so, and we added some other, we added the pattern rec. You guys, I'm sure many people listen to Mike Webster, who was working at the time on pattern rec and really helped to codify all those rules, and that lives in MarketSmith. And it really, really was a leap forward, because people don't realize how in years ago, Scott and I and Bill, we would go out and teach the technical elements of CanSlim, and we had no pattern rec. Like, we would have to just put a chart up and sort of draw out for people, don't you see the pattern right here? And it's really hard. It's like trying to teach someone for a beginner, right? It's very hard.
Yeah, Steve, and I was a customer back then trying to learn this from you guys. It took me a couple of years to see it, right? Because once you learn about the cup with the handle, all I saw was cup with the handles everywhere. But there's a certain cup with the handle we're looking for.
It's like going to a doctor who's been trained on reading an X-ray, and they all know what they're looking at. I look at an X-ray, I have no idea what I'm looking at. Right.
Exactly.
And, yeah, Scott and we're very fluent in that, because we grew up old school, where we didn't have any of those assists. We just had to look at the chart and talk to Bill a lot, and then really understand, like, what are we trying to discern here, and what is this pattern that we're looking for, and why is it significant? But the pattern rec was added, the screening was added, the alerts were added, the groups, the coaching. So Scott was gracious enough. I was busy working at William O'Neill, and helping to revamp this product. And Scott, you came in 2010, and we actually did the launch of MarketSmith in New York City. So the big reveal and the big opening day when it went live on the web was in 2010. It's hard to believe it's 10 years ago, and it was just an amazing team of developers that we had assembled. And interestingly, I hired most of that team away from the firm that was helping us. They all wanted to join, and they all had interest in the market. And I still have many of them. There's probably at least, there's probably at least 6 or 7 or 8 of those original team members working within the data analysis organization, because they just love a lot of the things that we do from an innovation standpoint. So,
and they're all very, very strong. A couple of things. Your listeners can hear our pride in the product. I can tell everyone firsthand that a tremendous amount of resources went into the construction of MarketSmith. A lot of thinking, analysis. It was a very large project that Steve headed up with a really solid team. And it was not a team of 3 or 4. It was really 8, 10 people full time. How long was the project from start to rollout when we did the New York?
I think it was 24 months, Scott, about 2 years, which is fast. We were meeting almost every day on the redesign and the whole concept and the brand itself, from the coloring and from the name. I love to tell that story because we work with a great agency up in Sausalito called Lexicon, and David Plasik, who's the principal, he's the owner of that agency. Their company named the Pentium, they named the Swiffer.
Wow.
They're just a bunch of linguists that sit around and come up with these fantastic brand names, and we were kind of homegrown, right? The name of the product was Daily Graphs.
Right.
Very literal, right? And
Exactly.
that tends to be how an engineer or a quant or a mathematical inclined person thinks. And we went to Lexicon and said, we got to come up with something that's going to really represent what everyone, what it, and they had some really great analysis on this. And they said, well, all of your listeners want to be Smiths and they want to master the market. We go, you're right. That's exactly what we're all trying to do. So
Yeah.
like a metalsmith or a silversmith or a goldsmith, you guys are all going to be market smiths. And that's really, it's a perpetual sort of challenge, right? I mean, that's why many of us love what we do in the market. It is this mystical puzzle that you just, when you think you've got it figured out,
Yeah.
It shifts on you a little bit.
oh yeah.
Just enough to throw you off. Yes, that's
Yeah.
true.
Yeah.
Anyway, MarketSmith, we're proud of it. It's a very powerful tool, and it actually is very elegant and easy to move through. But we should probably move on, Arusha.
Yeah, let's talk about, with shifts, let's just talk about some of the larger growth trends that are going on right now. And that's a huge part of CanSlam, a huge part of what we do. We're trying to figure out what's the next big thing. And then some of the stocks that are appearing from that. So, Steve, what are you seeing from a stock side, just from a trend side, that you can share with the listeners?
Well, I'll now. This is sort of our opinion, and it's a fundamental view, and I always like to engage in this because it helps us to not lean too much on the technicals. There's a tendency to just look at anything that's moving on the chart and just run and gun, right? And so,
Right.
The theme that I've been talking about, and I know Scott and I, at one of the workshops 2 years ago, and this has been a recurring long-term secular change, which is autonomous vehicles.
Mm-hmm.
We one of the fascinating things about CanSlim is that N factor, and if you were to look at Zoom, or if you were to think about Five9, or if you were going to look at, one of the themes right now is the coronavirus, work from home. What theme? Who's going to benefit? Right? Everybody knows the names: RingCentral, DocuSign.
Yep.
Zoom. There's a half a dozen names that are being floated around in social media, and anyone that's doing a little research can find them. The question to ask yourself is, are they offering something so new and so differentiated that we probably don't have any earnings risk over the next 2 or 3 years? And it really is drawing an audience, right? So if we go back and look at Qualcomm, or we look at Apple, or we look at Costco, or we look at Amgen, or we look at Syntex, we look at all these prior examples of great winners, you can always answer that question pretty clearly, that they did have a differentiated product, they had a competitive moat, they did not have earnings risk, and they were killing it with every earnings report, like, here we go again, here we go again. Those are really strong traits of a great winner, right? And it's important to think about that, because a new product or a new service with that moat will enable that company to generate a profit. And one of the primary premises of our approach is that stock prices follow earnings. They're highly correlated over the long term, right?
Mm-hmm. Right.
So we're always thinking through, when we're talking about the fundamentals, we're not just trying to compare trivia, right? Who knows the most about every little detail of the company? That never happened really in the O'Neill organization. That's not relevant, right? Our analysts wouldn't come in and who's the smartest guy in the room, because he knows every line item on their P&L, and he knows everything about semiconductor manufacturing. That's not what we look for. What we're trying to understand is what they're selling, what they're creating. It's more than mind share. It's real share. It's real market share, and it's expanding. And they have an edge, and it's going to be difficult for others to catch them, right? So you always ask that question when you're thinking about themes, and that's what I love about and is going to have the legs. And so I love the autonomous thing, because I know that when it catches, it will probably be very similar to when the PCs came about, and we had Microsoft, and we had Dell, and we had Compaq, and we had all these personal computers that no one knew about, 10 years earlier. They couldn't imagine having a computer at their house. And then with the invention of, the internet, all the services that popped up from there, and then the invention of mobile devices and computing devices, all the inventions there. So those secular businesses that really, really changed our day-to-day lives, I'm really fascinated by. So when we talk about these more temporal themes, like, well, we're going to buy, it's funny, I remember driving in one day when the virus was in China, and I was listening to CNBC Asia, and all the reporters were talking about all the mask manufacturers. You got to buy people in South Korea that make masks. And I kind of chuckled and I go, I know they're killing it. I know they're going to be like running 24/7, 3 shifts, but
Right.
that is not a sustainable business, right? I mean, if we can get through this, we're not going to have this virus in perpetuity forever and ever and ever, where everyone wears masks for the rest of eternity. At least I don't believe we are.
Yeah,
so,
and none of those masks are going to have necessarily a moat unless they come up with some proprietary thing.
Exactly.
Too, right?
Well, also being out there on CNBC, it's probably too late anyway.
That's probably you're probably late to the game. So be careful.
You're late.
Yeah, thematic. It's just my word of caution to people is I love doing thematic discussions. Like, hey, it's going to be 5G or it's going to be digital payments. That's where it's at, or it's going to be crypto or this or that. And I'll be quite honest. And I used to do a end of the year list of all the themes that I felt were going to occur in the following year. And I did that for like 2 or 3 years as an early portfolio manager. And every single year I was wrong. And I was just pathetically wrong on what I thought was going to fundamentally evolve. And a lot of it was because I had sort of biases, that recency biases, what I was reading or what I was listening to on television. And I still do think about those, because intellectually we're all challenged. We all want to think about what's happening in the world.
Now, Steve, did you try? So when you saw some of those themes, if you saw them break out, you tried them, but then you cut your losses, you let the market, the stocks tell you what to do.
Yeah,
intellectually you're wrong, but
like the 3D printing theme,
Yes,
that thing was like, it's so quickly fizzled.
Oh yeah.
And so what you have to do to counterbalance that. So we're all going to have that tendency to want to be the smartest guy in the room and be able to brag to our friends and relatives that I saw that, I'm the first guy in, right? Okay, whatever. That's all pride and ego. We want to put that aside. Really, what you also want to do is your screens. And you want to say there will be a theme in your screens. And you'll start to notice, as Scott said, there's going to be the top 40 groups we want to pay attention to, right? And we want to pay attention to the stocks that have good earnings, because if we're just buying story names, it's a crapshoot. But if we limit our screens to like the top 40 groups, and we limit them to a very loose screen would be a 70 or higher EPS rank. So now I've got the ones that are actually showing a profit, better profitability than 70% of the other names in the universe. Okay, so now I'm being smart about letting the market guide me. And then I look at those names technically and what's acting strong through relative strength. I start noticing certain recurring patterns just in the screen itself, right? Mm-hmm. It might be a digital payer. It might be a SaaS theme. It might be a China theme. It might be like, oh my God, Alibaba and JD and PDD, Pinduoduo are all showing really strong earnings, and they're showing good technicals. And I didn't even put that on my fundamental list. I wasn't even thinking about them. I don't, because I don't go to China, but they're coming up on the screen. And that's when you want to go the other way and say, okay, let the stocks give me a hint at what might emerge, then do my fundamental work and see if they've got the competitive moat, they've got the new product or the new service, and so on. And Bill was very good at doing both, right? We try to do both. We try to be very nimble in the way you're thinking about that next opportunity that presents itself. And so yeah, I mean, I'm always looking at autonomous. I don't know who the winner will be there. 5G, we know some of the primary players. I think China, an interesting theme is just if they can emerge first economically, there could be some interesting earnings reports. And I know they're still early in digitizing over there and using the web. That's why, PDD is a fascinating story in terms of, they're the Walmart of India in terms of the type of merchandise they sell. It's very, 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 very cheap. And a certain segment of the population likes to shop on that platform more than JD or more than Alibaba. And It's a very similar story to what happened in America when Walmart was addressing the underserved in the rural areas. PDD does that throughout rural China, right? And to people that are not as fortunate and don't have as much income. So, we look for those type of themes where we can remember from the past something that we see kind of happening today. One thing that Bill, here's an interesting little tidbit, and Scott, you might remember this, but one thing, Bill made a lot of money in healthcare, right? Amgen, Syntex, and that just is a universal. People are always looking to extend their lives and minimize pain and just avoid getting sick, and so healthcare is a really interesting space, right? So we always like to look there. The trouble is many of those names are story names. They're very story oriented. So if you limit your screens to the ones that are making money, you're going to end up with a much smaller universe. But that's fine with us. We want to see the ones that really do have some FDA approval or some competitive edge and moat. So healthcare has always been an area that Bill did really well. And the other area was, and he would always talk about thematically, and this continues to persist, is companies that help with communications, right? And I remember him telling me once about Xerox. And Scott, you might have remembered him saying how, it kind of dawned on him that a simple, dry copier was going to dramatically impact the way we communicated with each other, right? It's not telecommunications. It's just, we can actually copy material and give it to each other, put it in the mail and send it. It was this huge breakthrough in our ability to get closer to each other, right? And to be more efficient with our communications. And I've found that theme that ties into 5G, right? Ties into the Internet of Things. That is a very long-legged theme of just anything that helps us. And maybe we have to think about that, with this social distancing, maybe there's going to be a longing for, somehow getting reconnected. But
well, Zoom kind of plays into that with that communication thing.
Exactly. Right? Yeah, it does. Yeah. And so then,
I remember one time Bill telling me that he actually, back to your communication point, he considered the railroads at the turn of the century a process of improving communication instead of just looking at it as transportation. Interesting twist.
That is really interesting.
And they were, Scott, because they laid the telegraph right next to the railroad tracks. So it really was, and they had a telegraph operator at every railroad station. So, he was dead on. Now, here's the thing, like let's talk about Zoom or any of these other thematic ideas. If you buy one, you go, okay, I waited for the follow through. So I'm trading in harmony with the market, and I waited for the perfect technical setup. There are three decisions you have to make. I tell people this. You have to figure out, what am I going to buy? When am I going to buy it, and how much? Now, what I'm going to buy, you've used your thematic, lens to determine, I'm going to buy something in communications. Maybe you pick Zoom. You're using your technical skills because you're reading the charts and you're using pattern rec, and you're really being disciplined about entering the trade, right? You also want to think though about how should it behave? Now, I'm not going to talk about how much. That's a whole nother call and topic, is really your weighting in the portfolio. And that really gets down to kind of your conviction that you've got a big fish. You've got one of these model book stocks, and that's where you can really parlay and amplify your returns by not just buying once and sitting there, but really understanding what you have. And it's going to show up when I say, well, how do you know you've got a model book? Well, it's going to show up when they announce their earnings, right? Because we see this in all of our models. They're going to come out and they're going to shock you.
Yes.
They're going to shock you at how much they're growing their sales and their profitability and their earnings and you're going to go, oh my God, I wish I owned that business. I wish I was the owned the whole business, or I was running that business, because that's amazing, right? And that's what you want to see in your holding, right? If you buy the wrong one, you buy a stock in your theme, and they kind of have a tepid earnings number, and you're like, oh, I got the theme right, but I got the dog in the theme, right?
Time to exit.
Yeah, you got to exit. And you got to figure out how to get the leader. And Bill would always challenge us on that. He goes, you want to get the best stock in the best group, and you're going to be validated. Number one, it's going to rally. You're going to have other like-minded growth investors running into that name, and then they've got to deliver. And you're going to get validation that you've got a big fish when you get that earnings, right? And that earnings comes out, and they should blow away your number, and they should tell you up their guidance, and you're like, yes, it's working. And then their ability to do that quarter after quarter after quarter is going to come down to their ability to execute as a growth company. there were a lot of people that were poo-pooing the Apple iPhone. Oh, it's got a glass screen, and who wants to type on that? And BlackBerry is going to dominate. Well, where's RIM, right? Where's Apple?
Right.
Well, and there was a big tug of war. And Scott, you remember, we had RIM, we owned it. It was a model book stock, that was
for a while,
for a long time, as was Nokia, as was Motorola, right? They all had their day in the sun. And when Apple comes along, there were people saying, oh, it's going to have its day in the sun, but we're negative, it's going to go this way. Let the market prove to you that they are still winning, and they do it quarter after quarter of showing you through their revenue growth and their earnings growth that they really are dominating. And that's what happened with Apple. And that's where many of our listeners probably, because I know I've talked to them at workshops and ourselves in our family office, we really were able to reel that fish in. That Apple trade was a real wealth builder for many, many people. And again, that's the beauty of what we're all doing by engaging in the capital markets is millionaires were not just Apple employees. There were people that never worked for Apple, but they had the wisdom and the smarts to buy the stock, to understand that it fit the profile and enjoy that appreciation because they were shareholders in a great, great business. And that's ultimately what we're trying to do, right? With every one of our buys, we're hoping that we're going to get another one of those big winners, like an Apple, like a RIM. But you really, you have to train yourself not to fall in love, because if you're making a lot of money, you're going to think it'll never end, and you got to be very dispassionate. And like BlackBerry and Motorola and Nokia, some of these names will fizzle and go to zero. And so you have to understand the life cycle of your holdings. They're not, I'll buy it and hold it forever. I mean, capitalism is a brutal, system where, we have this creative destruction going on. If you can't compete, as a manager of the business, you're going to probably, shutter. And you guys know the numbers, restaurants and small businesses. And Scott and I run a lot of businesses, and we know how difficult it is. That gives us a real appreciation for when we see a company generating 25% sales growth. We're like, that is amazing.
All right.
So
to quantify, let me quantify that point for the listeners. We have model books, as everyone knows, that go back to the 1880s, and even 20 years ago, the vast majority of those companies don't exist, or they're in a different form or shape. Right, Arusha?
Yeah. It's remarkable how quickly they're either acquired or they're trumped by someone else. Like Apple coming in, putting BlackBerry in trouble, or Nokia.
Yeah.
Yeah, and I want to go back one last point on what Steve was talking about Apple, just for the listeners. Big moves take time.
Yes.
And so once you've got a good cushion and you're pretty comfortable with the market trend and how we follow the market, you want to step back and give it room and let the cushion build, because it's simple. Big moves take time. And we're talking about multi-years. I mean, Apple's been very good to our shop.
And I'll say, another thing that Bill would remind us, when we would go into a bear market, and there was I'd always remember that it always seemed to come about much quicker than you wanted it to. You just felt like I didn't have enough time to make the kind of money I wanted to make during the last bull market. They took the punch bowl away too fast. It always felt that way, right? Mm-hmm. But Bill would always say, and he was sort of, he had that very optimistic view. He'd say, look, the bear market performs a function. And that function is to set the stage for the next bull market. And so you're going to have companies that struggle and they won't survive. And you're going to have other people out there that are innovating and saying, look, I just got a good idea, and they're going to get funding, and there's going to be an IPO in the next 5 years that none of us know anything about. And we're going to go, where the hell did this one come from? Right. And so that's on the horizon. It's not apparent today because we're in the middle of this big correction, but it is on the horizon. There are people going to their jobs. They're clever. They're smart. They're thinking about how to change something or make it better. And they're not going to be held back. And they're going to get risk capital. And then out of the blue, you're going to come up with this growth name. Right. And so, always if you get down and you feel like, oh, there's nothing to do, you just remember we're laying the seeds for the next bull market. And then when it comes about, to Scott's point, if you've got one of the great winners, you're going to have a time to ride that. And it'll take time, but you'll be well aware of, understanding what you have and knowing its fundamental profile, its technical profile, and know that, look, I'm not going to just sell it on the first little wiggle and get spooked. Or if I do, I'm going to understand that, I'm going to have to understand how to read bases and read the chart to know where to get back in. And that's what makes it so exciting. I mean, you can't tell the market when you need money. It's going to do what it's going to do. And you have to have patience. And so you have to have enough wherewithal to survive during these difficult periods and just take risk off and raise cash. And it takes time to learn that. I've been in the market for, God, I think it's now 32 years.
30 years.
Yeah, 30 years. And so, I remember what it was like when I was just starting, and you just think you can make money every time you go in there and put a trade on. And as you get older, you just have more of a memory for the ebbs and flows of the market. And hopefully your listeners will learn from this. This is an unbelievable experience for everyone to put in their memory bank and remember, because we're getting sort of a witness to mass psychology. We're getting a witness to government intervention. And this will go down in the history books as equivalent to what happened during the Depression. I don't know if we're going to go into a depression. No one knows. But that was such an extreme situation of decline in wealth. And we're having the same thing go on right now, that, if you can survive this and keep your powder dry and be really about, smart about the way you trade, there will be a period in the future where we're back to normal and you're going, hey, it's actually easier. It seems to be working. I'm not getting chopped up, and the growth names are really delivering, and you'll see the valuations. This happened in Scott, I think it was like in the prior to Reagan, it was in the 80s, early 80s, 80, 81. I was going through one of the model books that we have. We have all the examples, and I think Market Smith, we send those out. Mike just finished that, didn't he? I think he finished the
top stocks book.
Top stocks of 2019. It's
yep.
Kind of model book. We have these big volumes in our office that we've compiled going back to the 1800s, and in many of these bear markets, it would always shock me how much the multiples compressed, right? Because many of you listeners are probably used to, you've probably been trading during the 11-year bull market where valuations were pretty expanded, right? They were, people would get nervous about valuations being too high. And I saw so many great growth names where the earnings were growing at 35, 40, 50%. This is in the 80s, right? This is in that cusp when we were moving, the Microsofts, the Wang computers, and we were moving towards computerization of the business and then eventually the home. And man, I mean, if you're value centric and you're afraid to buy high PE stocks, that was a phenomenal time to get into that 82 bull market. We might have a similar situation here, right? Where they're just taking everything out to the woodshed and they're just crucifying every name because it's panic selling. And, we might find that as they build the right sides of their bases, these stocks rally up on the right-hand side. You're not going to buy it at the absolute bottom, and you don't want to because you don't know where that is. But you might end up getting these things at very, very reasonable valuations, so you're not going to have a valuation risk. And then, they deliver on their earnings. You'll say, okay, I'm actually got the wind at my back, and it's starting to get easier. So that's the scenario that I hope plays out for everybody that's following this approach. But we take it day by day. We remain flexible, and don't try to project. Just interpret that action day by day.
I'm here with Scott St. Clair, and Scott is one of the senior product coaches at Market Smith. Now, Scott, we've both been doing this for a long time, and we know that investment research takes a lot of time. There's so many factors that you want to look into to try to figure out whether this is a stock to buy or not. Quarterly earnings, huge sales growth. Hey, are institutions buying it? The list goes on and on.
Yeah, it's a common question. I hear it all the time. I don't have time to do this work. So you don't have to spend that much time. If you have a tool like MarketSmith, we do a lot of that work for you. Right there on the chart, earnings, sales, group strength, institutional sponsorship, like you just mentioned.
Right.
It's all there in the chart. So it allows you to make a decision much easier.
Yeah, and the beauty is that we have in-house analysts that go through the SEC filings. They pull out those numbers and they put it right on the MarketSmith chart, and all you have to do is analyze them.
Yeah, I couldn't imagine having to go to the SEC website and look at the income statement, et cetera. That sounds like a lot of work.
Yeah, and that would take hours and hours, and in that time, you can go through hundreds of stocks and find the best ones. So don't miss out on a big winner because you don't have enough time to research it. For more information, go to investors.com/podcast2020.
Let's quickly go through a few ideas that have come up on the radar. So one of them is Atlassian. Now, we're familiar with it in-house because all our developers are using their products with Confluence and Jira.
Yeah, I mean, this is one, if you're just listening, it's Atlassian is the symbol is team, TEAM. It came out in 16 as an IPO. So it's relatively new, had a beautiful prior uptrend, built a recent base, has a 94 relative strength rank. And what's interesting, I'll just talk, Arusha, about the process, and I'm not any name that Scott and I mentioned. Look, we mention them because we're familiar with them. It doesn't mean that we, as a matter of fact, we're 0% invested right now, so we're not even in the market, right? So none of these names we own. We just are watching them and we're thinking about them through that checklist, right? And go back to, so when you look at a chart, I'll just share with you my process. If you look at a chart on MarketSmith, you kind of can go through this rotation of looking at the earnings. So CAN, SLIM, CA is the current earnings, the annual earnings, and you're checking that. And you go to the quarterly block in the lower left-hand corner, and you can see here that the earnings are up 48% on the December 19 quarter, 40%. You verify that it's not, some accounting work, that they are actually growing the top line, 37, 36, 36, very, very consistent top line growth. The annual numbers, the annual estimates going forward in 2021, 27% earnings growth expected, and it was revised up recently of a little triangle there. Those are the first things I look at, really, are the earnings. And those are the first things Bill would look at. And if we showed him a stock that had no earnings, he would just dismiss it and say, why, don't waste my time. I want to know that they are running a profitable business. Mm-hmm. And then you go and you start to look at the chart. So, and the earnings are usually used, you're trying to qualify them from a fundamental perspective. Is this even something I should be paying attention to? And yes, you've got the earnings, you've got the ROE, you've got, the ROE is 29% for Atlassian. When you go in, so I think I know what I should maybe be buying. That's the what should I buy. Now, when should I buy it? And that's when you're really looking at the chart. And in this current environment, you really want to pay attention to the relative strength line, the relative strength rank. And you really want to see if you can find a buy point that offers a low risk entry. There are definitely higher risk buy points. People that are I'm going to use a piercing of the 200-day moving average on the upside, or the 50-day, or I'm going to use a shakeout +3, or I'm going to use a pocket pivot, or whatever you want to call it, right? Those are higher risk. Now, why are they higher risk? Because we profiled what these patterns tend to look like before a stock begins its big move. And so when Bill writes about 5 or 6 common patterns, and they're all ranges, right? They're a double bottom, or a cup with handle, or a saucer, or a flat base. They're all essentially ranges that the stock trades in. And we know that a stock behaves a certain way before they make their big move. And you're trying to validate that the stock you're looking at is exhibiting that same behavior. And if you can't validate that, then the pattern has not evolved enough yet. It hasn't, there's something anomalous. And that means it doesn't fit our profile. So that means there's a higher probability that it may not act like a great winner when it breaks out. It just might be really volatile. It might break out in reverse or whatever. So we're really trying to evaluate the pattern. And so the one thing I'm going to call out to people, and I know if you're just listening, you can't see these, But really, you got to go back to the rules on, well, how long do these ranges typically last? Flat bases, I don't know, 5 to 7 can be as short as 5 weeks, 7 weeks. But, typically, when you read Bill's work, these bases can tend to last 13 weeks, sometimes as long as 15 weeks. But 13 weeks happens to be, the length of time of a quarterly reporting cycle, right? So when I look at, and Bill would go through and count every week of the base. And if I showed him a pattern, he goes, well, it's only got, we're looking for 13 weeks. If it's a cup with handle and you've only got 6, he'd say it just hasn't formed yet. And he said, we got to be patient. We got to wait for this thing to form the proper base. And that's kind of where we are right now with many of these. There are not many stocks that really have put enough time in as they've been range bound. But as you build your screens, you should be writing them down. And you might have a dozen or 2 dozen names that, hey, it looks kind of okay, not too broken. And then in another 4 weeks or 6 weeks, that list will grow and grow and grow. And you'll say, what changed? Well, what changed was time went by, and time will heal these wounds. And you're going to see names that are showing really good relative strength in both the ranking and the RS line. That means they haven't gotten pulled down with the general market. They're holding their own. That means you don't have that same kind of panic selling. Why don't we have that in Atlassian? Well, it's a great growth company. It's growing the top line and the bottom line, and it's offering a service that's probably going to continue to grow if we work from home. And it's a service that's relatively immune from the shutdown, right? So
and the institutional sponsorship is not selling. They're selling other stocks. That was a very good summary on that, Steve. The only item I would add is when the listeners pull it up, the team on their MarketSmith chart, the relative strength line is well into new high ground above the price. And that's another bullish indicator. But everything Steve went over is exactly how we've been trained. It's kind of clockwise going through the chart. And one other point back on the earnings that you had mentioned earlier is I remember many times Bill highlighting if you had earnings growth annually where it was just that steady, Freddy, consistent earnings growth year after year after year, that gave him that little bit of extra confidence. But that was a good review. That's exactly how we do it, everyone.
And you can see if you look at the nice thing about the MarketSmith chart is we also plot the S&P 500, and that there's a thin black line that just shows you the closing price weekly of the S&P. And directionally, Arush is highlighting that. You can see the big drop in the S&P, but then you can move your eye down to what this stock did, and it didn't.
Good one. Divergent.
Yeah,
exactly.
That helps you to understand that's why the relative strength line is at a new high, right? It's just holding up so much better. One of the things that we've also noted and studied, and many of you probably read, is that there tend to be patterns like base on base patterns that occur in a stock while you're going through this difficult down market. You've got stocks that want to break out, but they can't break out, and they just build another base. And so as you build screens or as you're looking at names, you just need to teach yourself what is going to be a typical pattern that's generally bullish. And then, Scott O'Neill and I would look at this, and we're not at all bothered by the fact that this stock is not that far from its all-time high. Many people are going to say, oh, but you got to get over that. This is a very basic concept that novice investors are afraid to buy things that seem to be near their all-time highs, and they just don't believe that they're going to continue to go higher. But when you look at these historical models, we see it over and over and over again that strength begets strength, right? You want to avoid, and weakness begets weakness. So if you're going to be a bottom picker and you're going to present us a stock, if you were to give us a name and say, here's one, I love this. And I look at it and the first thing I see is it's down 70%. What about Marriott? Should we buy all these travel companies? I think how about Carnival Cruise Lines, right?
Right.
Well, let's pick the bottom.
We're going to say, okay, you got to go back to the book and read, right? and we're going to say they don't fit the profile of a great winner, right? You're right. This is, intellectually and conceptually, maybe you're right. Maybe it's overdone, and maybe they're going to get a big bailout and all the casinos are going to come back screaming higher. and it's going to be a V bottom. But
but you don't know.
We don't know, and we did not see that when we documented these thousands of great winners from the 1800s to today. We got a big library of them. We just don't see that pattern, right? And so you want to go with the higher probability bet where here's a company this is not going to be a travel company or a hotel company or a cruise company that's going to just take it, on the earnings where God knows when their earnings are going to turn around. These guys have no leverage, team like this, just from a business perspective, this is a much better risk profile than something that's down and out, and Bill would always say, you get what you pay for. You're buying something that's 70, 80% off its high. It's got to go up 300% just to get back to where it was before the correction.
Right.
When's the last time any of us bought a stock that went up 300%? So, the odds just are against you if you're a bottom picker. You want to go back and recalibrate your thinking about why are we so interested in finding the bottom and get comfortable with buying things that are showing good relative strength and good highs. So, yeah, I know we're jamming a lot of great lessons in here, Arusha.
Exactly. I was like, you're giving them a PhD right now.
Oh yeah, it's been 30 years of trading, but it's all fun.
You want to do one more stock?
Yeah, let's do one more stock, Steve. Steve, your choice.
Oh, I don't know. Let's look at JD.
Let's pull up JD.
Chinese. I talked about PDD and JD. We can look at all three of them, here's JD.com, this Chinese online retailer, and I'm just curious about. Their earnings were triple digit there, and then they slowed down 14%. The top line has been really consistent around 20%. 13, 19, 24, 22%. 15% return on equity. If you contrast this stock technically with, I'll put up Alibaba, BABA, and I'm looking at Chinese names only because I'm intrigued by this idea that maybe China's the first to rotate out of this and maybe recover economically, but we'll see in their numbers. You guys should clearly, if you look at these charts, there's a real difference in which one seems to be, Alibaba's holding right at its 200-day, has a 91 RS, has a really, RS line is hitting a new 5-year high, but it looks to me like Alibaba is still forming the left side of its base, whereas JD looks like it's consolidating more and sort of calming down. So, I'll sort of thematically shortlist this. And if we look at PDD, okay, I got 3 names in China. They're all in the B2C space. They're offering, and I know that there's a secular, trend over there. PDD is, now the negative on PDD is they're just, they had a negative 12%. They're not making money, right? And they're not expected to make money until 2021. So this is going to immediately, we would disqualify them if we were being really orthodox. And I wouldn't just say, well, but they're going to be the Walmart of China. It sounds cool and it sounds intriguing, but we would wait for them to print some profits, right? Because the sales growth is phenomenal, right?
Yep.
They're at 1.5 billion in revenue in the last quarter, right? And their sales growth is unbelievable, and there's no denying that.
Yep.
But maybe they're like the Amazon. I tell the story often. I would go to Bill O'Neill with Amazon and suggest that we maybe put that on our approved list that we could purchase. And every time he would turn me down, and he would always say they have no earnings. And we never traded that stock, even though it had a big move. And so we were being very orthodox. And then sure enough, when Amazon finally, started to turn a profit, they weren't reinvesting in robotics and automation on the plant floor, and we saw their first profit. It did form a base, and it did provide a proper pivot, and that's when Bill put it on. So, you're probably better served being really orthodox longer term, rather than always kind of making exceptions. Because I know people get into trouble. You make one exception here, then you make another one over there, and another one over there, and before you know it, you're not really following any rules. You're following the exception to the rule, and then you get into trouble, right? And
right.
And so this one is definitely much more speculative, but it has a 96 relative strength rank. It's actually in a pattern here. It looks like a base on a base. We had a cup, it rallied, and then it sort of sold off, and it's just sitting on that prior base. So that's a very typical. We see that often with leading stocks. They just base on base while the general market's grinding through its bear market. And then when the market does its follow through and it turns, typically those base on base type patterns will be the first to really run. And they'll almost like a spring that's getting wound up, where there really was no desire for the owners to sell. You didn't have any real selling pressure. Like Scott was saying, the institutions knew what they had. They weren't interested in liquidating this. They're gonna own it for the longer haul. And then others are like, man, these guys are, still killing it on the earnings. And so then you have new buyers coming in, and then that would make for a nice move in that stock, a nice rally that hopefully we can capture. I'd like to talk about process. I don't know. I don't have any other names.
I'll throw out, much slower, more conservative, but I like Microsoft. I actually owned it before the market break, and let's see how it forms now. It's come down on the left side, but that's another one. Potentially the relative strength line is well above the price, where the price is.
Yeah, these are good, solid, what we call defensive growth names. The earnings have been accelerating 21%, 21, and then 37 in the last 3 quarters. Top line consistently growing at 14%. Good margin expansion. Buybacks, and this is you're not going to get the same kind of daily action and juice, and you shouldn't be desiring that either. But I would go back and ask, what are they doing from a innovation standpoint? What are they doing? I know they're changing to a service-oriented model rather than, and they've done a very good job at doing that.
Yeah, and Microsoft's also a good example of how a new CEO can come in, change the culture, and that's what Satya Nadella did by changing the direction more towards a service-oriented company, and really changing the fortunes of Microsoft.
And that
good point. This could just be, a counterbalance. So you have a few higher octane names, and then you have Microsoft.
Right.
Sometimes Scott and I will talk about weighting the portfolios or barbelling them with a core growth holding that's a little more defensive growth, like a Microsoft, or even an Amazon, or an Apple, something like that. Big, liquid, a lot of good sponsorship, but they are growing, right? And then the other part of the portfolio is going to be a little more speculative, a little higher beta. Definitely, they need to be showing higher growth, not like a Zoom, for instance. I mean, if Zoom is one where I'd be really nervous of having all my chips on that one name, because I just don't know whether the follow-on effect. They have a lot of free users. They're going to definitely have a good quarter, but I don't know if they're going to have a good second and third and fourth quarter. And so that thing could run up and it could run right back down on you. Microsoft, on the other hand, has good earnings visibility, great management, a big moat. So, barbelling or diversifying your own little portfolio with a more stable growth name versus a more high beta growth name is also not a bad strategy when you're trying to mitigate the risk of this crazy environment.
Mm-hmm.
That's perfect. So any other last words? I mean, you guys have spent almost 2 hours sharing your experience here. So I greatly appreciate it.
Well, Rusha,
I would just say patience, and we will get our opportunity. Patience.
Yeah, I would love to come back in, let's say in another quarter, maybe in 3 months, where we'll, if we know bases need to form, and if we don't know if the ultimate low is in, and if we come back and do another podcast, we can kind of revisit what we talked about today, and then see what the tape did. Right? Did we get some failed follow-throughs? Did we actually have a bottom? Where did that leadership come from? What were and that would be a nice recap if we should put that on the calendar, and I'd be happy to do that in July.
That's it for this week on Investing with IBD. Next week, we will have Thomas Lee on. He is the managing partner and head of research at Fundstrat Global Advisors. So that's it. I'm Marusha Paris, and thanks for listening.